This is a brief overview of impairment of held-to-maturity securities or equity method investments as well. Earlier in the course, we talked about impairment of assets. That was back in Chapter 11. We had flowcharts then that covered different assets. Well, since investments are assets, we have to once again consider the issue of impairment. Remember that when we know there's an impairment in value, GAAP requires that we take a loss and reduce the value of the asset to its new lower fair value. That stays the same in Chapter 12. And one thing that makes impairment somewhat simpler in the investment arena is the requirement that 2 of our 5 investment categories are already reported at fair value through net income. So if a trading security or a passive investment is losing value, we're going to already be recording those losses through net income as they happen. Available for sale securities are also reported at fair value, but if you remember, the unrealized gains and losses for this category normally go through OCI. So GAAP requires available for sale impairments to flow through net income in certain situations that complicate things. I won't be testing you on available for sale impairments, but you could learn about them if you would like to in one of the Chapter 12 appendices. But for the remaining 2 investment categories, held to maturity debt investments and equity method investments that are not reported at fair value, we have to consider the possibility that there are triggering events that may indicate an impairment loss has occurred. And if so, we record a loss and reduce the value of the investment to its impaired value. The way we get there is very straightforward for the equity method investments. The new value is just the current fair value of that equity investment, and we make an adjusting entry to bring our current balance equal to that current fair value. And the other side of the entry would be a loss on impairment. For the held-to-maturity debt investments, we are just going to focus on credit losses in our discussions. This means our best information tells us that the bond issuer is not going to be able to make all of the interest and/or principal payments on the bonds. So to account for the loss, we re-estimate the present value using the original market rate priced in the investment and using our revised projection of the ultimate cash flows. This will always result in a lower number than the amortized cost on the balance sheet. The difference between the two is the impairment loss. GAAP actually makes the company estimate this loss up front, similar to the way you estimated bad debts on accounts receivable. You have activities that cover the impairment loss calculations for held-to-maturity debt investments. So as always, ask me any questions that you may have.